much less risk down. The fund, we believe that the strategy here is similar to core equity, and that really is due to the fact that the risks that are inherent in investing in mezzanine debt structure. So although you're senior to the equity position, you are junior to the more to the other senior to the equity position, but junior to the senior debt positions. So thus, in the event of a significant market downturn, you could potentially see an impact at this level. However, the downturn would have to eat through all of the equity first, and then come into the mezzanine position, which would be a substantial downturn, if you will, to ultimately impact this level. Brookfield does take a conservative approach to the use of leverage, which is very consistent with their other debt funds, which you are invested in, that Paul mentioned. They do not anticipate using any fund level recourse indebtedness with this strategy to ultimately leverage the debt investments that they're making. To date, the fund has acquired 13 assets for total commitments of roughly $400 million. That is different than what was in your materials, just simply given the transaction volumes that they've seen over really the course of the last few months. We've highlighted a couple of competitive advantages in here, as always. Really, in this case, I would include that we highlighted the sponsor and their experience in both real estate equity as well as real estate debt, as well as the attributes of this particular debt strategy find quite compelling. So first of all, Brookfield, as many of you are aware, a very large publicly traded asset management firm based in Toronto. Although they're headquartered in Canada, they have a significant presence around the globe. Today, they employ over 7,000 individuals across the globe with a market cap of roughly $40 billion. They have assets under management of roughly $285 billion, with real estate being the majority of that at $160 billion. The firm's experience in real estate really dates back over 100 years. They had their roots as a single entity owner operator, investing really on their own behalf. They began to expand that in the early 2000s, bringing in third-party capital, and since that time have really established a significant private funds platform. They've raised over $88 billion, with about $27 billion of that coming from the firm itself. So a significant amount of third-party capital really dating since 2001. While this is a newer, open-ended fund with a limited track record, as Paul did mention, they have an extensive track record in debt that dates back to 2004. That closed-end fund strategy really focuses on new loan origination as well. However, higher yielding mezz, so assets that have a bit more hair, if you will, on them. They may be a lower vacancy, there may be some redevelopment, et cetera. That fund does target 13% gross and 10% net return. Lastly, we also favor this particular strategy within debt as compared to some of the more risky debt strategies that we see. Those riskier strategies are utilizing leverage, so they're buying loans and then leveraging those loans so they can buy even more loans. And furthermore, the asset level risk on some of those competing products is also increased. So much more transitional type assets, where these are largely stabilized core assets with strong current income coming from them. The last piece that I would mention here is that because they are originating the entire loan, this really enables Brookfield to determine the attachment and detachment locations within the capital stack, so that they're consistent with the property level risks that they're loaning to. They're not purchasing prepackaged syndicated loans or tranches. They can thus avoid over-lending to particular assets. They can avoid complications due to those large syndications, and they can also ensure that the documents are not borrower-friendly, that they are lender-friendly. And so, because they're the ones that are ultimately originating the entire loan, it really enables them to have the control and ultimately determine who their counterparties are going to be as well within the loans. That's not to say the strategy is without risk. We've mentioned that in a number of those risks in the documents. I would highlight really here just the potential concentration risks that exist, given this is a newer strategy. Really, the inception was early this year, and really only 3 quarters now of performance. At that time, as I mentioned before, of our underwriting, there were only 7 assets, and those were all office at that time. Today, we moved forward, and we have 13 assets today, and over $400 million of exposure. So a lot of that concentration has been mitigated. However, you should be aware that this is an open-ended fund, and why do you invest in an open-ended fund? One of the reasons is so that you have potential liquidity that can on a quarterly basis. At these early stages, when you do have a smaller portfolio of assets, that could be maybe somewhat put in jeopardy until the asset base becomes much larger. You could also potentially have a loan that could influence the overall portfolio. Now, as I mentioned before, we do believe that this is largely being mitigated as the fund continues to grow in size. They raised a substantial amount of capital. They anticipate deploying roughly $250 million on an annual basis. And so the fund is growing as you would expect, on a quarterly basis, as you would expect any open-ended fund to do. So with that, I'll pass it over to Andrea and to Chris to give their prepared remarks.
Mr. Chairman, members of the council, thanks very much. It's good to be back. A number of familiar faces. I mean, it's interesting to listen to Jack give the history. We now have a history with the SSC that goes back 8 years. We're very proud, but also humbled by the success we've had. And frankly, a lot of that success is because of the partnership we've had with SIC. And you were one of the first U.S. investors that we had of size to come and work with us at Brookfield. So we're very appreciative of that. With that, I lead the investor relations for the Western U.S. I've been lucky enough to be around since we started the relationship, so I thank you for that. But beyond that, Andrea is the talent, so I'm going to let her talk specifically about this one.
Thank you, and thank you for inviting us back to present. I think the last time I was here was 3 years ago when we were talking about Blood 4, which you're invested in. I'm very happy to report that that fund is in the harvesting period. It's fully invested. We're in the process of recapturing our capital. We expect to meet our target returns there, roughly at 13% gross, with a 1.2, 1.3 times multiple. So thank you for that. This fund we're talking about today is our senior mezz fund. Is a natural extension of the business that we've been doing at Brookfield on the debt side since 2004. We were in the process of investing. We now have 5 flagship mezzanine funds targeting higher risk, more transitional assets. In the course of investing that capital, we came to the determination that there was a really strong opportunity in what we call the senior mezz space. So that's basically loans that are average 70% loan to value, relatively stable properties with current cash flow. And we can originate those loans to generate a mezz piece with a 7% gross return, 6% net. So how do we do that? We go ahead and we reach out to a borrower, make them an offer to provide them with a whole loan, and then we make a determination to sell off the first mortgage loan and to keep the mezz loan and create that mezz loan to achieve the target returns. We've deployed over $5.5 billion in capital since 2004. And that's a small percentage of the loans we've originated since we only retain 20% of any loan. I'm proud to say that we're one of the largest and longest running debt platforms. We've been generating, we think, great risk-adjusted returns for our investors since 2004. Our strategy is pretty simple, whether it's in the high leverage or low leverage. We want to lend against high quality properties in major markets and at valuations that we think will less than long-term intrinsic value. We're very careful when we look at every piece of real estate to ask ourselves, what do we truly believe this real estate is worth over the long term, and not get caught up in a single high per square foot lease that someone might view as scarcity value. We very much use all of the resources available to us at Brookfield. We have a 20-person team, but we reach out to everybody within our real estate division to provide us with information to really help inform our underwriting and due diligence. Ultimately, the decisions are made by our team with approval by our investment committee, but we use all of the boots on the ground throughout the U.S. to give us market data to help us make those decisions. And we think right now it's a compelling opportunity. Coming out of the global financial crisis, there was a lot of new bank regulation, and that is keeping banks more cautious in their lending, which has helped prevent the kind of overheated markets that we really saw in pre-credit crisis. Just a quick snapshot of Brookfield and our mezzanine lending platform. We have 5 closed-end funds. There's 1 open-ended fund, 1 one separate account, 26 investment professionals, including our accounting teams. We've done over 100 real estate lending transactions since 2004 and 11 billion of real estate originations just in the past 5 years, of which we've kept a smaller percentage. Moving on to a little bit more on Brookfield. Brookfield is one of the world's largest alternative asset managers. We've got a 115-year history of owning real assets, and getting into the managing money for third parties is relatively new within that 115-year history. So we look at every deal as if we're going to own it, we're putting our capital into it. We're very disciplined in our investment approach. If we think that the market is not compelling, we're not going to make an investment. There's 750 investment professionals out of our 70,000 employees located in 100 different offices. When you look at the 160 billion of real estate, it's really throughout all of the different property types. So we've bought, 70 office assets, 49 of retail, 10 of multifamily, 4 of logistics, and 23 of hospitality and other. And that's really just to say that we have the ability to tap into market intelligence in any property sector that we're looking to lend in. Our strategy, as I mentioned, is simple. The real estate quality is the primary driver of our investment decision. We're going to use the combination of Brookfield's real estate expertise with our team's finance expertise to make our investment decisions. We're always going to make sure our loans are structured in such a way as to protect ourselves in the event of an economic downturn. And I'm kind of proud to say that that strategy proved out for us through the global financial crisis, in our first 2 funds. The strategy of originating a home loan and syndicating our first mortgage has worked very well for us. First mortgage lenders have a lot of capital as long as you're staying within certain bands, the lower loan to value bands. So we found a very deep market of people willing to buy the first mortgage loans we originate.
The other thing I would say too is, going back to the last financial crisis, what differentiated us is because of our real estate background, the ability to actually take things back if we needed to. A lot of other lenders had to kick the can down the road because they actually really didn't have the ability to take it back. Sometimes you don't want to take it back, but just the threat and the fact that you could is motivating. And I think you'd see through the last cycle just how well we were able to come through that because of that background and because of that ability.
I think that's right. When we're looking at a real estate lending opportunity, we really do kind of 2 different types of analysis. First, we do our thorough equity due diligence to really understand what's this piece of real estate worth and where are there possible hiccups in the capital in the cycle of the loan. And then secondly, what's the right loan structure to put in place so that this loan will perform throughout the duration that we're providing. So page 8, just briefly, what we see as the Brookfield advantage. Senior members of our team have on average over 20 years of experience and have been successfully investing in real estate credit at Brookfield since 2002. We've got extensive relationships with borrowers, with mortgage brokers, and with financing sources that we've cultivated both in our prior careers and in that time period at Brookfield. Our team is fully vertically integrated, so we don't outsource. We have an origination group, underwriting, closing, asset management, and financial reporting. So the people who are involved in originating the loans, our junior team, are involved in the day-to-day asset management. And we think that's great because it gives them, they learn from if something doesn't go right, they learn and make better investment decisions in the future. And also they've got our senior level team sitting with them every week talking about any asset which might be on the watch list, and we're getting in there early if we think there's a potential problem. We are, as I mentioned before, we're leveraging the broader organization to get real-time market data, and we're able to make a quick decision. So some of the deals that we're getting a great opportunity on, it's not because of the lowest price, and it's not because we're giving away structure. It's because somebody's buying a property, and they're coming to us and saying, I've got to go hard on my contract in 40 days, and we're saying, we like this loan, will you be there for you? We have investment committee every Thursday. I can sit down on a Thursday with the senior members of our investment committee, get sign off on a deal, and subject to the due diligence proving out, borrowers know, because they've been working with us for 15, 16 years, that we're gonna do what we're gonna say we're gonna do. So just kind of the last thing, just to point out, page 9, why senior mezz loans? We think there's a good opportunity for gap capital, due to increased commercial real estate maturities. The market is totally accepting now of mezzanine capital being an integral element of the capital stack. Real estate fundamentals are very strong. And the opportunity is these loans provide current income and high risk adjusted returns. And we feel that it's a great corollary to equity portfolios because you're getting your current income. You're not waiting for, it really offsets the J curve of some people's equity portfolios. You have downside protection, you have roughly 30% equity value at the time you make the loan. And our structure provides us with a lot of control in default. So we control on those positions so that if a borrower does something wrong, we're in a position to act immediately and don't have to wait for somebody else to approve that. So I guess with that, let me stop and see if there are any questions.
Okay. Just simple questions at the outset, just remind me to the principal. Is there a lockup, a two-year lockup on this investment?
Correct, there is a lockup, yes.
That's what I thought. So we're not liquid at all for 2 years. 2 years. Okay. And the fee structure, the effective amount is?
100 basis points.
All flat throughout.
Correct, there's no
And
incentive.
no carry. Okay.
If I understand correctly, and if I read this correctly, you have the potential to leverage, but you haven't chosen to do that. Could you talk a little bit about that, about the idea that whether or not what would be the set of circumstances that might cause you to do that, since you're allowed to, and why haven't you in the past?
Okay,
As
correct.
we all know, that became a dirty word in 08,
Exactly.
and
That's right.
and following, so I'm curious as to what your response is there.
So since 2008, in our, graph 3, 4, 5, and with our liquidity fund and separate account, we have not used any leverage on our portfolio. Fundamentally, we don't like the way leverage is structured these days. We don't like repo because effectively your lender owns the asset and, they can take it, you can fight about it later. We don't like the fact that when you're doing leverage, even though, some people will look at first mortgage strategies and say, it's a levered first mortgage strategy, is that less risky? What we don't like is effectively all your assets are cross-collateralized, and there's some recourse to the fund. What would change that is if we were able to obtain a financing line to finance first mortgages that would address all of the things we don't like. It would have to be non-repo, it would have to not be market, it would, so that's probably why we haven't used any in the past.
It's a fairly stiff set
8 years,
of requirements right there.
Yeah.
Thank you, thanks.
The same vein, who tends to be your counterparty as you strip out the underlying? Is that
So when we sell the first mortgages, it's either banks or insurance companies. So we probably transact.
broad base?
Sorry.
Broad base?
Yes, yeah, it's a very broad base. We try to be careful that if we, once you've done a deal with someone and then you do 2 or 3, we kind of try to move on to somebody else after that. So it's a very broad base of first mortgage lenders.
That gives you a decent market for that.
There's a very deep market for that right now. We typically before we sign up the deal, sign the term sheet, we have an idea of where the first mortgage is going. And more times than not, by the time we close the loan, the first mortgage closes with us. Sometimes, and then when it doesn't, it's usually 75 to 80% of the way done with their work, and they just need to buy it later. So we typically know.
Tends to be kind of a market rate, so there's a lot of negotiation of the pricing on that.
Well, what we'll do is we'll go to 3 of our, counterparties and ask them all to bid on the transaction.
And just a point of clarification, we use the term syndication, but these aren't being syndicated like into a CMBS pool, right? These are one-off transactions with reputable lenders.
And that's actually a point of competitive advantage for us, because a lot of borrowers don't want CMBS because it's difficult.
So I assume there's no recourse back to you once it's sold.
Correct. We just are selling, they own the first mortgage, we own the mezz,
Right.
and we have an intercreditor agreement which says if the borrower defaults and we foreclose, we have the right to take over the first mortgage, but we don't have the obligation.
Other question, Tim,
Thank you. Jack, I got a question for you, I think. On your page 11, our page 24, and the municipal funds based asset management fee is unfavorable relative to these two factors.
Just that this fee is slightly higher than we've seen in comparable products. So, and I think if you flip to the farming page, page 12, you'll see what the average is, and it's around 90, a little north of 95 basis points, so you're a couple basis points higher than what we deem as the average in the market. Not to say that there aren't any others that are at their level, but it is slightly higher
And why the comment is unfavorable?
because it's higher,
Just that one or two basis.
by 1 or 2 basis points.
I guess the next question, since this is not, I was trying to find where I saw it, but it was like 6 or 7% return is all we're gonna get on this. Why are we putting this into like non-core fixed income?
Non-core fixed income. You know, we just think, so here's sort of the real estate space right now. Core real estate is now expected to generate returns of, sort of in the 5.5 to 6.5% gross rate. So by taking a little bit more risk here, but still being very mindful of the downside, having a 30% equity cushion behind us, we do think we're getting maybe, 50 basis points more than what core real estate is offering. So, I mean, we think this is appropriate. We think it competes well with core real estate. Now, as to putting it into fixed income, that may be more of a Vince question.
Yeah, Mr. Treasurer, the non-core fixed income portfolio is mainly corporate risk. This is more real estate risk, so we're putting that on that side.
Other questions?
No.
Okay, ready, Linda, please.
Based on the recommendations of the Council Investment Committee, Real Estate and Real Return Advisor Townsend, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve a $75 million commitment to Brookfield Senior Mezzanine Real Estate Finance Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, any comments before we take a vote? All in favor?
Aye.
Are there any opposition? Votes? Passes on unanimously. Thank you so much.
Thank you so much, appreciate it.
Our next, presentation is the BlackRock.
Yeah, sorry.
Pretty obvious,
All right, so we're going to discuss the BlackRock Global Energy and Power Investment Fund 3. I have Mark Florian with me. Mark is the CEO of strategy, and Kathleen Ellsworth, who's the Director of Investor Relations. And for Townsend, Seth Marcus is going to cover this commitment. Staff and Townsend recommend a $100 million commitment to BlackRock Global Energy and Power Investment Fund 3, which is a closed-end commingled fund that will acquire core plus and value-add energy and infrastructure assets, predominantly in the U.S. and Latin America. The fund targets net returns of 11 to 12%, with an average current cash yield of 7 to 11%. BlackRock is targeting a total fund of $3.5 billion, although I think you are probably going to make your hard cap of $4.5 billion. This is a follow-on investment to New Mexico's $100 million investment in Fund 2, which is currently showing a net IRR of 54.9% and expects to deliver a gross return of 26% or so over the full life of the fund. I'm just going to summarize before turning it over to Seth our exposure with BlackRock. We are in the BlackRock Global Renewable Fund 2 for $50 million. BlackRock Global Energy and Power Infrastructure Fund 2 for $100 million. That's the predecessor fund to one we're discussing today. And then today's Fund 3 for another $100 million. That's $250 million of BlackRock exposure in the real asset portfolio. So I think with that, I'll just turn it over to Seth to discuss Townsend's.
Thanks, Paul. So thanks again for us being here, just to present this opportunity. So I'll reiterate a little bit of what Paul mentioned. So the first, of the prior commitment to Fund 2 is actually under the First Reserve name and an organization. So that's outlined in our recommendation. I'll just talk about that for a moment. So, or I'll talk about that as part of our recommendation. But, so Fund 2, raised in 2014, as Paul mentioned, the IRR is very high. There's actually been 2 realizations in that fund. So this is not, projected IRRs. There's been 2 fully baked deals. One of them north of 100% IRR that's really driving that outsized return. So that's about $260 million of invested capital that's been fully realized back to you all. So just to reiterate, that's realized performance. So in short, the fund will really target a few different sectors. First off, the conventional and renewable power generation is roughly 40 to 50% of the fund. This is power generation from clean technologies, as well as traditional fuel types. Really contracted, highly structured transactions focused on wind, solar, hydro, natural gas, and geothermal. Also focused on midstream energy assets, another 40, maybe 50% of the fund. This will be a combination of regulated and contracted midstream oil and natural gas infrastructure with a focus on existing gathering systems here in the U.S. Then the balance, the remainder, maybe 10 to 20% of the fund in more transmission, distribution, other energy assets that are still regulated, but gas utilities with transmission distribution assets, with contracted assets, including floating storage, ships, or other equipment with long-term contracts from large energy companies. The fund will focus on assets with asset-backed companies, really operating assets at the energy value chain with a focus on contracted midstream power. These will be larger transactions, so the average equity check in between $100 to $350 million. When you think about the size of the fund, we'll be getting with 15 to 20 investments throughout the life of the fund. There may be the ability to co-investment. These are large transactions. So BlackRock is offering 2 different co-investment opportunities, which both staff and Townsend are evaluating. One is discretion to the investors, to the LP, who will be involved in the decision. The other is discretion to the manager, where we commit to the co-investment and the manager makes the decision on where the co-investment is allocated. So we're reviewing those opportunities as we speak. Consistent with Townsend's investment recommendations, this one comes with a number of really competitive advantages that we see, as well as a couple of potential issues and concerns. From the advantage side, this is a strong, if not one of the strongest teams in this strategy that pursues really conservative risk profile. Paul mentioned core plus value add risk profile, has a strong overall track record of performance, and very competitive or appropriate fees for this space, which is somewhat of a rarity in the sector. Quickly on the fee side, so at a $100 million commitment, the SIC will pay 60 basis points on committed capital and then 85 basis points on invested capital during the investment period. That's a 5-year investment period. When the investment period ends, that transfers or turns over to 145 basis points on invested capital. So there's a lot of different numbers there. Really, what we looked at when we modeled the assumed fee is assuming an even deployment of capital over the time period, and as well as capital coming back. The management fee would be approximately 115 basis points on the $100 million. I did mention in my opening remarks the acquisition of First Reserve by BlackRock that occurred in 2017. We liked the team when they were First Reserve, if you were here a handful of years ago, and we still like the team today. We did have some initial concerns during, prior to our due diligence, prior to our underwriting, regarding the acquisition, given BlackRock, public company, and the large organization that it is. But we did become comfortable with that during the due diligence process. So we're confident that the team responsible for Fund 3 is well aligned. They're incentivized to stay engaged throughout the term of the fund, as well as energy sector expertise, and their ability to source transactions remains unchanged under the BlackRock umbrella versus under the First Reserve. There's retention packages in place. Additionally, BlackRock co-invests into the fund 2% of the fundraise, and $15 million of that will be coming from the team. So when you look across the 3 funds that they will manage, there's over $50 million of personal co-investment into those 3 funds, well aligned there. The team has been given, and over since the 2017 acquisition, we believe the latitude to really operate mostly independent from BlackRock with really little interruption the prior funds. And lastly, the fund will remain, will maintain a link to the First Reserve through sourcing agreements in place. There are senior leadership at First Reserve that remain on the investment committee of this fund, really to create continuity across the fund vehicles. So the two individuals there are voting members on the investment committee that actually are personally invested into the fund, so they are aligned with the fund and have been actively engaged since the initial close since the BlackRock transaction. So with that said, I'll hand it over to Mark and Kathleen to go through their comments.
Thank you, Seth. Mr. Chairman, members of the council, SIC staff, Townsend Aon, and esteemed guests. We just want to start by saying good morning, and it's truly an honor and a pleasure to return to this beautiful room, certainly to serve you as an existing manager and to speak with you today about Fund 3. So thank you for that. As Paul said, I'm overseeing investor relations and co-investment, which we'll discuss, and have been with the fund since inception. When it started at First Reserve, I was at First Reserve for over 25 years, and have been with Mark Fleury, our group head, who has been the group head since inception for over a decade now. And as you'll hear from Mark, really our mantra is we think things are working very well. We do think we have a defined and sustainable competitive advantage in our strategy. And what you're going to hear is just a continuation of those same tenets of our strategy in Fund 3 as we've been utilizing and proving up over the last decade. So with that, I'll turn it over to Mark.
Thank you and good morning to everyone. And I just wanted to add my thanks for the investment in Fund 2 and the support and partnership that we've had over the past several years. This is, what we're discussing, is a third generation fund. We were established about 10 years ago, and we're very excited to continue the same strategy. Obviously, markets change and we need to adapt, but our strategy, we think, has served us well over the test of time. And so on page 3 of the document, maybe I'll just make a couple key points and quickly move through our fund and how it works. We're equity investors in energy infrastructure, and that means long-lived energy assets, power, midstream, some of the things that Seth discussed, where we can get contracts for revenues over a long period of time. To give you a sense, in both our first and second fund, the average remaining life for revenue contracts is 11 years. It gives us a lot of visibility in terms of revenues over time. I'll discuss that in some more detail in a minute. We are typically control investors. We want to control the company so we can add to it, make it better, de-risk it, do things to generate the type of cash yields and returns that Paul was talking about. So control is a very important thing to us. How do we control these investments? Well, a big part of how we do that is we go out and we talk to energy companies around the world every day. Some subset of 400 energy companies that we target to create joint ventures, to create investments where we help the company in some way, at the same time create an opportunity for us to invest and shape an investment well for our fund. So proprietary sourcing of investments is a key tenet of what we do. We currently have $2.1 billion in commitments in Fund 3, and we're looking forward to hopefully closing the fund towards the end of this year, first quarter. It's on page 3. You can get a sense, and it's really reiterating what Seth said. Power, midstream being pipelines and storage, utilities and other heavy assets in the energy space typically can carry these long-term contracts or regulated, stable regulated regimes. And so that's what we're focused on. 75% of our investments have come from this proactive origination where we go and talk to the company about a strategy, how we can help them grow, how we can help them recirculate capital out of infrastructure assets and other parts of their business, some strategy where they will talk to us one-on-one. We avoid competition for those investments as a result. Another key thing that we can do since we're negotiating these investments is we can structure them. And we're focused on yield, as was mentioned, and also downside mitigation. can we get contracts in place, insurance, can we allocate risks in the investment to minimize the risk to our investment? And so that's a big part of the whole negotiation discussion that we have. The other thing that's really important as well is we're energy specialists. We live and breathe energy every day. And that means we have a lot of folks like myself that live and breathe the industry and love it. But we also have operating engineers and business managers inside our fund, not just financial investors, but real business management, operating engineers that know how to fix a power plant, to take care of a midstream system. If something goes wrong, to mitigate any risk and or how to make it better. So we have a lot of energy expertise inside our team. We have about 30 investment professionals.
So we say we have people who come to work every day in loafers and steel-toed boots, and then I added sensible pumps.
That's true. So on the following page, we just want to briefly give you a sense of some of the themes we see in the energy industry that allow us to have opportunity. First is a shifting energy mix, and this is something we hear about in the press quite often. There is a move towards coal-fired power, certain types of power in power space, towards wind, solar, and natural gas is a lower carbon alternative to coal-fired power. So that's a big shift that is deploying tens and tens and tens of billions of capital every year. There's increased energy mobility. What we mean by that is that, as an example, natural gas, it used to be a resource where if you produced it in a region, you used it in that region. You put it in a pipe and deliver it to an end user for power, for heating in a home, a commercial and industrial building. Now that natural gas can be frozen to minus 260 degrees Fahrenheit, put in a tanker, sent anywhere in the world. And so it's become a global product. The value chain of taking it from where it's produced to an export terminal, the export terminal itself, the ships, the import terminal on the other side, and then the end use, that all requires a ton of infrastructure and capital costs. We've all heard about aging infrastructure, and that is a big theme for us. The average conventional power plant in the United States, for example, is around 25 to 30 years old. There are a lot of power plants that are still operating after 50 and 60 years. That needs to be replenished and replaced. And then finally, there are a lot of energy companies that have decided to outsource their infrastructure. They don't need to own every part of the value chain. And so that's an opportunity for us. We're out talking to these companies about how they can outsource their infrastructure to us. We do have a page on page 5 that talks about that things change in industries and you need to be aware of them and you need to adapt. I'm not going to go through this in any detail, but I think, our approach of talking to industry partners, our approach of working on bespoke solutions for them while trying to shape investments for resiliency over time is key, and we need to be aware of market trends and adjust to those. Page 6 in our presentation is a really important page, and there's 4 key building blocks to how we make investments. First is the sourcing. Again, 75% of our investments have been an exclusive one-on-one negotiation with the company. That allows us to shape investments, and our goal is to have contracted revenues, a lot of certainty in those, expenses that we can manage over time and optimize. And when we use debt, we use long-term amortizing debt. The goal there is if you can lock revenues, lock expenses, lock your debt service, then you have a lot of visibility in the cash flow that comes out the bottom that we can distribute back to
That's the
our
yield,
investors.
the 7 to 11% annual yield target.
And then once we own an investment, we've shaped it in this way, operational improvements. There's certain investments that we focus on just incremental operating efficiencies. I think the power plant is being that way. You sold all your power forward through this contract, and so you've locked revenues, you want to minimize risk. And those tend to be very dividend-heavy investments, which is good. But we also have other investments where we have a baseline of revenue and a very nice business, but we can grow it. It might be a pipeline system where we can grow from 1 or 2 customers to 10 or 15 customers, and that's where we can generate a lot of value add. And then finally, on exits and monetizations, we get a lot of comments from investors that there haven't been a lot of monetizations in the infrastructure space. We've actually had, well over 2 billion of realizations, so we proved the thesis, we believe. Just a couple of quick more comments. We think ESG, is incredibly important, and so we focus on this. In fact, we have 14 areas, very structured in the way we go through our due diligence when we're considering investment, 14 areas that we consider, 7 of those are ESG related. And over 90% of our portfolio is reducing carbon footprint in what we're doing, so we think that's really important. So in summary, we have a team that's been around a long time. If you look at the managing directors and the team, average over 20 years of experience. We are aligned, we are all investors in the fund. Every vice president, director, and managing director is an investor in the fund, that's mandated. We spend a lot of time on origination and trying to craft bespoke investments for the fund. And then finally, we feel like we have a big sourcing network through our team, but also through the firm. The firm has over 70 offices around the world, and we've been taking advantage of that BlackRock platform to drive business forward. So I thank you very much for having us come today. Open it up.
Great, so, let me just start with a simple question. Contracted revenues, those fixed or from the MA contracts?
Typically, they're fixed, and so for a power plant, you would get so many dollars
Right.
for every kilowatt hour you produce for the next 20 years. And there might be an inflator in that.
Oh, there might be.
Yeah.
And just remind me of the deal with First Reserve, you bought the funds, or you didn't buy the company?
First Reserve had 2 products, energy private equity and energy infrastructure funds.
Right.
First Reserve continues to exist and it's sort of with a back to basic strategy that focused solely on their energy private equity. BlackRock bought the energy infrastructure fund product line, and 40 of us were working at First Reserve one day, and the next day we were working at BlackRock. But
You got
ironically,
raised.
we didn't move, and we didn't move in the same office,
Still
so
the same
you drive in and say hi, good morning to Earl, the security guard, on the same parking spot, and everyone says, how's your new job? And we're 40 of us together in Greenwich with the same investments in our portfolio, the same investors, and then, oh yeah, there's this BlackRock that our job is to take advantage of that, for your benefit. Product lift out is what they call it.
All right, thank you so much. Questions? Scott, please.
In Townsend's report on page 5, it's our 85, we talk about the fact that there's not language regarding a no-fault general partner agreement, and that you recommend that we ought to negotiate that. If we're not successful doing that, is that something that we feel so strongly about that would be a deal killer? And do we have other similar type investments that don't have that type of language?
I'll answer that by saying I'm gonna push very hard for that decision. I'm not willing to concede at this point. If there's anyone in the room that we're willing to walk away from that ask. But I would say that when you're talking about dissolving, getting rid of an asset or a fund, typically you're worried about fault thresholds. If the manager makes a mistake, and what's the threshold for that? That's what you're most worried about. No fault is a really rare occurrence. That is your investors saying, you know what, you didn't do anything wrong, but we're gonna sell out the general partner. And in most investment shops, BlackRock would be one of them, or any place else, the threshold's gonna be so high on a no fault because the GP's not gonna give up their business. So at the end of the day, it's probably not the hugest issue, but from an investor standpoint, typically investors want over guidelines. You tend to see some no fault threshold, but probably be at 75 or 80% anyway. And good luck with getting 75 or 80% of the investors to say you want to get out of here for no fault reason.
So given that answer, I'll ask BlackRock this question: why would you guys not allow us to have that language? It's so rare where it would ever be enacted.
I'll be the non-lawyer, but I tell you what on TV, that just, as you did an excellent job explaining that, it's, it could harm other investors. And if an investor wakes up one day and says, no fault, did nothing wrong, but by the way, I kind of changed my mind. We're buying these assets, signing contracts, 15, 11-year contracts, holding for 10 years. It's very, it's it could be extremely disruptive, and I don't think in all the investors' interest. Others may want, the manager to go on. It could cause a lot of, friction, confusion, distraction, and, we could have a lot of protections in there if we are doing something wrong, obviously. And one of the things we liked about going to BlackRock is their strong fiduciary culture. BlackRock is known as a fiduciary, they don't have the conflicts that other shops have, and it's about the clients first. We also did make some significant changes in terms of, I'd say the most significant in my view is, transitioning to the European waterfall structure. So there's, I think, a lot of, there's a lot of protections, but those things to me are not, black and white, that is, a benefit to all investors.
Thank you. Do we have other investments where this language doesn't exist?
It's rare, but the thresholds are so high at this point with private assets going into such vehicles, public vehicles, that the threshold of 80% is comfortably, you're never gonna trigger it anyway. You're basically having BlackRock saying you're not gonna take our business from us for no fault reasons. It's a big proprietary issue for the manager.
Thank you much.
Other questions? Linda?
Based on the recommendation of the Council Investment Committee, Real Estate and Real Return Advisor Townsend, SIC staff, and the general fiduciary oversight of RDK, I move that the State Investment Council approve up to a $100 million limit to BlackRock Global Energy and Power Infrastructure Fund 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Any other discussion? All in favor?
Aye.
Any opposed? So unanimously, we have another so much.
We're very honored, and it is my birthday today, so. I'm a living example of aging infrastructure.
House? Sounds like a Chinese truck.
Oh, very good. You have to have a good sense of humor. Thanks, Will.
We're bringing forward today the TPG, Sixth Street Partners Tau Contingent Fund. I have with me here from Axia, Tim Ness and Jen Wildman. And from the Sixth Street Partners side, Cheryl Cicchini and Brian Darcy. And staff and Axia recommended a $100 million commitment to the Tau Contingent Fund. We've been with TPG on the private equity side for since 2011, and TPG originally was founded in 1992. And the Sixth Street Partners, which is the private credit arm of TPG, was founded in 2009. The Tau Fund itself is a diversified platform investing across the risk spectrum, and we will be investing into it on a contingent basis, where our funds will be deployed contingent upon an economic or market dislocation of some sort. This allows us to build out our non-core fixed income portion of our portfolio, and balance this with our concern of investing into the current late cycle economic environment. This fund will fit into our distressed and other subcategory of the non-core fixed income, and on a exposure basis, invested plus committed, we will now be fairly well balanced between the three subcategories of structured credit, lending strategies, and distressed and other. At this point, I'll pass it over to Axia to give you their perspective on the fund.
Before we pass that point, so the contingent aspect of it is so unusual. I don't know if we've had any of these before. Just one.
We had one other.
Yeah, I just, for some reason, don't remember it. I saw it. Material. Do we call this committed funds? I mean, how do we handle this from an allocation standpoint.
So, yes, we would consider committed funds in the non-core portfolio, but like Clark's saying, don't get all until conditions are right.
So we find ourselves under allocated to this segment for a long period of time, if we're lucky.
Well, ours are pretty high, yeah. As these guys will explain, I'm sure. So, yeah, hopefully we'll become committed.
I'm not sure if I hope that.
Yeah, we see the current environment being one of a lot of money chasing relatively few opportunities. And on this contingent basis, we'll be able to invest into an area where money tends to dry up in a crisis environment and opportunities tend to expand.
Yeah, I didn't mean to interrupt, but it's such a, the council needs to focus on the unusual aspect.
Right.
Ken says it's our second standby commitment. Yeah, Jennifer?
Good morning, Mr. Chairman. Thank you council members and staff for having us. We're pleasure to be here. So, as Bart mentioned, we're presenting TPG Sixth Street Partners Adjacent Opportunities Contingent Fund. I'm just gonna call them TPG and Tower Contingent, so I don't run out of air today. So you're obviously familiar with them from the private equity aspect. Tower Contingent is being presented as part of the non-core fixed income allocation. We've been working closely with staff and we feel we have a pretty compelling pipeline to work through over the coming months. This is sort of the start of that. And as we mentioned, the last presentation we had here was earlier this year with Silver Point, the contingent fund. So we're sort of following along those lines. At the end of the second quarter, the total non-core fixed income allocation, including the unfunded commitments, is approximately $2.5 billion. Long term, we expect to get the overall portfolio to about $3.3 billion. We've worked pretty closely with staff over recent years to build a very stable base. So we have commitments and investments across direct lending, diversified structured credit, distress, and as Bart mentioned, it's fairly well balanced at this point. So we're going to look to continue to diversify into differentiated strategies, sector geographies. I think we're a little bit heavy on North America, and that was done by design, but we may look to build that out. This particular investment as well, I hear the concern with the contingent style, but the reason we like this is should a widespread distress cycle occur, you're well positioned to take advantage of that. But you're not paying fees prior to that, and that's important to us. Also with all the investment in this portfolio, we're building it out with well-established institutional platforms. CPG is one of those, with very seasoned professionals across a variety of strategies. So, we see TPG being able to take advantage of different opportunities, not just simply positioning for one particular distress cycle. Have Tim next year with me, who did all the work on this fund. He's our head of private credit strategies. So I'll just go on with this.
Well, that's very generous, saying I did all the work, but thank you. And we recently completed due diligence on our contingent for consideration and corporate income portfolio. As everybody's mentioned, the fund is managed by the credit arm of TPG Capital, better known as TSP, or TPG Partners. In general, this is a team or platform that we actually really consider the best of breed in the private credit space. Since they were founded in 2009 by some former leadership members from this special situation, they really effectively executed on their business plan to build a very a leading platform. And that includes a very strong franchise in distress and special situations, direct lending, both in the US and Europe, in what they are now calling TPG Capital Solutions, which is more growth debt or structured equity, and then something they call TAB, which is more of a diversified product, income-oriented, or credit-oriented, which gives you some exposure to those first two buckets that I mentioned, but a variety of adjacencies, which we can talk about what some of those are, but really thematic income-oriented opportunities. As I mentioned, this is the team that we've supported and completed due diligence on several of those products and clients invested. TAL, the strategy has really three components that I think are worth mentioning. The first two are smaller pieces of them. I would think about them as almost co-investing alongside their core distressed and special situations platform, the distressed, the direct lending business, and then the biggest piece is the adjacency piece. And that's specific to that, and that's specific to TAL. So what is that? There are a number of different components to it, and I'll let Brian elaborate on this further, but this could include healthcare royalties, real assets, agriculture finance, runoff insurance portfolios, so very sort of creative, less correlated opportunities that you generally are not seeing in investment portfolios. This also may include stressed corporate credit, but not truly distressed, where you're looking to take over the business. So if the broader corporate credit markets trade down, things that are trading at meaningful discount to par, but the likely exit is to just be refinancing at par. Overall blended TAL, I would think about it as 15 to 20% gross return. So when you're getting some exposure to some of the top investments or the distressed investments, those could be higher end, and then some of the direct lending exposure could be at lower end, so lower double digits. Presently, TAO is a $9 billion, and this is the fund that you would be investing alongside if the contingent option is taken. It's currently a $9 billion evergreen vehicle with 3 to 5 year lockout. That fund and strategy are completely closed right now in the hard cap setting. And it's important to mention the TPG does not have any separate accounts for this strategy. So that's the amount of capital that you invest in these top strategies. But as everybody's mentioned, they are raising $3 to $4 million for this contingent vehicle. The way it'll work is that there's 3-year activation period, at which they can trigger this vehicle and start investing alongside the core talent. And then there's a 3-year investment period during which they may invest that capital and then subsequent harvest period. Effectively, I would think about this as almost a hedge or insurance for the portfolio with the volatility and distress cycle does pick up, which there are numerous signs that we are in late stage of the credit cycle, which is really the timing component, which is hard to really hard to capitalize on. So what do we like about them? As I mentioned, that we think they have a fantastic platform overall. They have a great track record in each one of those different verticals I mentioned. The top product, which is their distressed special situations, which you guys are also invested in, has consistently been hitting their targets. TAO has been generating mid-teen plus and higher returns since its inception. TSLX, which is their US direct lending platform, is one of the top direct lending platforms in the market. And frankly, if you look across their entire platform of over 100 deals that lost their money in, the majority have been highly successful in line with their expertise. I would also mention that they've really done a great job from a sourcing perspective. They have 20 individuals that's really their primary focus is finding interesting deal opportunities. They have great experiences, I mentioned, finding really things that we think are off the run deal flow, so things that you're not seeing in standard distressed or special platform. And we think we've been highly effective at finding really interesting thematic ideas where it could be taking advantage of a very discrete opportunity set. And we will just mention that it's a large and highly skilled credit team. They've done a great job of recruiting not only from Goldman, but some of the top people in the industry. I just think that the success of the platform. It's been a stable team, no partner level departures since the founding. And the scale we think is a real advantage. And I think Brian's going to be talking about the big portfolio they purchased, which is over $1 billion portfolio. There are very few teams that can now look at $1 billion+ opportunities and have bandwidth to look at those and the capital to execute on those sorts of situations. Furthermore, it's important to note that their corporate distress track record has been very solid, and industry feedback has been consistently very, very strong overall. They have a very strong following amongst the LP community and they are trying to reach the others. Lastly, I mentioned contingent structure, as Jim mentioned, is really an idea we like. We think it's a good opportunity to earmark some capital for what we do agree is large and pending as distressed opportunity set, particularly in the corporate credit space. There are no fees being currently paid, as Jim mentioned. And it will be at TSSP's option to trigger the contingent. So they're a platform in general that we trust, and we think there's strong alignment, they'll do the right thing, not just the, drawing this capital to start on additional fees. They have a reputation at stake here. We have several of their large partners in town, other partners, also the contingent vehicle, which we think is also a strong endorsement. So bottom line, since they've started in 2009 and really executing on the business plan, we think this is a very solid team, and differentiated strategy versus peers. So the client seeking a core credit allocation and a partner to as we're thinking about the next distress cycle. So unless there are any immediate questions, I'll pass it off to Brian and Cheryl.
So with that, I'd like to start by just reiterating Jennifer, good morning and thank you. Thank you all for having us here. Appreciate you taking the time, appreciate the opportunity to discuss this potential partnership in Tau Contingent. I sit on our limited partner relations team, and I spent a lot of time personally, along with Brian and the other TSP partners, working through the Tau Contingent structure, specifically with our LPs, to create a tool and a part of their, their private credit, their broader portfolio. And so we can certainly go into any of that, but with that, maybe I'll turn it to Brian.
Yeah, thanks, Cheryl. Thank you to everybody for taking the time to meet with us and letting us present. My name is Brian Darcy. I'm one of the partners at TPG, and specifically TSSB. Before I get going, I thought I'd just say this is my first time presenting here today. And I know some of my partners at TPG have been here in the past. I tried to do it the right way. I ate at La Chosa last night and then TSSB this morning, and I literally don't think I'm going to eat again until Friday. So I just wanted to get that out of the way. Look, I think it would be helpful, Tim gave a pretty good overview of our background in the different fund complexes, to give you a sense of how we invest capital, talk a little bit about the Tau program, and also the genesis for why we're doing the Tau contingent vehicle itself. How we've invested capital for the 10 years that we have formed TSSP, and also the 10 years prior to that when the founding partner group was together at Goldman Sachs, is we are highly thematic investors. We are constantly, as a partner group, debating 68 different themes. Now, some of those could be dislocation themes, some of them could just be something interesting. For instance, we become the third or fourth largest owner of avocados in the United States because it was an interesting special situation investment we could make. We distill down those 60 to 80 themes into the most executable, actionable 15 to 25 themes. We build sourcing machinery around that, both internally and in some cases externally, and then we go attack that thematic. If we're doing our jobs right and we're identifying those types of themes early on, generally speaking, because the world is so efficient today, you will see those types of opportunities exist for the first 9 to 18 months, and then capital will see the types of returns we're generating form around us, and that's really the point in which we hold what we own or sell back into the market. And so we'll talk a little bit in this presentation about Tau, how we have a thematic approach to investing. And generally speaking, when we talk about themes, we're really talking about finding in any given thematic, unless it's an outsized theme, 3 to 5 deals in a theme, and then moving on to the next one. If everybody has the presentation in front of them, I'm gonna hit a couple of pages. Page 6 is really the first page I'll hit here. As you see on this page, this is the scope of the TSSP business today. As Tim alluded to, we really cover the full gamut of everything in the private credit and special situations world, everything from distress to direct lending to growth debt. And as you see here, visually represented, Tau is really the broadest vehicle that we manage, basically spanning everything we do inside of TSSP other than our CLO business on the right side of the page. So to spend a minute or two on Tau, let's flip to page 11, which gives a nice overview of really what Tau is and a couple of the characteristics there. And we'll get into Tau contingent specifically. So the Tau portfolio really is the full expression of all of the thematics we manage here at TSSP, not just the control or direct lending or growth debt, but everything in a single portfolio of risk. Same strategy which we've been executing on for 15 plus years as a partner group. As Tim alluded to, we are very proud of protecting capital in downturns and obviously making returns in good markets, bad markets, and benign markets. what you've seen across TSSP in our history is a less than 50 basis point loss rate. And so that's something which we're very proud of. I've heard in some of the other presentations a discussion of leverage. Interestingly enough, for the 10 years the founding partner group was investing capital before TSSP, the bank had a mandate that we could not use leverage. And so our formative years of growing up as investors was really investing in unlevered types of securities. And that continues to be true for everything that we do in TSSP today. So on the fund as a whole, we don't do fund level leverage. We have a de minimis capital call facility, which we simply use to smooth capital calls. We move once a quarter ideally from LPs. But at the asset level, and this is bullet number 3, over 85% of everything we own in Tau today is top of the capital structure, first dollar risk. So in the event investment doesn't work out, we will be the first to be paid in the event of a liquidation. We generally have a focus on cash yielding assets. So today Tau runs at probably a high single digit cash on cash return, and 86% of the portfolio is cash yielding. The last point I would mention on Tau as a whole is we pride ourselves on having a differentiated sourcing engine inside of TSSP. So we have a business unit called the Pentagon, which is comprised of 20 individuals whose primary role is to go out, organize by thematic, and find opportunities. And if we're doing our job right, we should have a differential portfolio versus other managers. And so today, even for the size of portfolio that Tim mentioned, nearly 3/4 of our portfolio is totally differentiated, meaning no other GP is in the company or capital structure. Flipping over to page 13, I'll just briefly mention, we talked about the different thematics that we approach. This is an example snapshot of the types of thematics which we're pursuing across Tau today. Slightly different than a dislocation market, most of the thematics we're approaching today are going to be defensive. They're going to be very intentionally oriented towards top of the capital structure, and they're going to be investments that we put on with the knowledge of saying we do expect significant volatility, potentially a hiccup in the growth pattern in the coming years. We want to invest in assets which we consider very safe and which we think will hold value in that type of environment. But this is a good snapshot of those types of themes we're pursuing in Tau today. I'll briefly touch on page 14, which is just a snapshot top down of the current Tau portfolio. This should be fairly consistent with everything we just talked about. One point I would mention here, as investors, we are generally developed market investors. So you should not expect to get emerging market exposure, Chinese MPLs, Brazilian distress as a part of this portfolio. Most of what we're going to do is going to be US and European centric. Generally expect to be 50 to 70% US, most of the balance over in Europe. So if I touch on Tau contingent, that's Tau kind of in a nutshell. Look, the genesis for Tau contingent relates to where we're at in the life cycle of the main Tau vehicle. We think long and hard about the economies of scale of our business, and we also think long and hard about the diseconomies of scale. So you reach a point when you say to yourself, well, I don't want to have to be $700 million deep in my 80th best idea, because that's not what's best from an investment perspective. And so with that in mind, for the main Tau vehicle, we have closed the vehicle and said for the foreseeable future, we feel we are right sized for the next 20, 30 years on a steady state basis for the amount of capital we manage in the Tau program. However, if you see a market environment where there is severe volatility or there is a full-blown distress scenario, in that type of window, there is a period when you can drive outsized type of pipeline and outsized types of dollars because of that market environment for a finite period of time. And so rather than go raise a larger pool of capital into Tau, which is a quasi-evergreen vehicle, which we will always have to manage that larger denominator, we thought the more intellectually honest way to approach this was to put in place a vehicle that when and if that type of market environment occurs, we could tap on that vehicle, dive into that dislocated market, and when that dislocation pulls back, return the capital to the LPs and go back to that steady state size denominator that we manage in Tau. So that's really the genesis of what the Tau contingent vehicle is. The way we have set it up is we have a 3-year window in which we could activate the Tau contingent vehicle. So you should think about this as effectively a call option over the next 3 years on a distressed or dislocated type of environment. To give an example of the types of deals and the types of potential portfolio shift, that you would see in TAO for that type of environment. I would point you to page 25 and 26 in the presentation. So we saw a little bit of this type of environment in late 2015, 2016. When I believe it was November of 2015, over a 2-week period, we saw the bank loan market trade from par to 88. That credit market collapse late 15 eventually led into an equity market collapse early in the first quarter. You started to see this type of volatile environment, though prices recovered. In that period of time alone, TSSP put out somewhere around $2.5 billion over only 3 or 4 months. Most notably, one of the transactions which got a lot of press at the time, which was a pretty differentiated transaction that Tim alluded to, on a quasi-exclusive basis, we went and we purchased the entire North American distressed debt business of Credit Suisse in a single transaction. So it was a $1.3 billion equity check that we wrote for the business, no leverage. We had 60 people staffed on it for 5 weeks who, and I'm not exaggerating, literally did not leave our offices for 5 weeks underwriting that portfolio. That portfolio today is on track to do somewhere around a 50% IRR and close to 2 times our money. And so it's the ability, as Tim said, to have a large team of people managing the appropriate amount of capital, but also being able to flex into those types of environments that we think sets us apart and is pretty differentiated. Page 26, excuse me, and I'll pause after this. This is just a good page, I think, to illustrate how you potentially see the regular steady state TAO portfolio mix change slightly in a dislocated scenario. So the top of this page are pie charts which depict the current TAO portfolio exposures. The bottom shows the portfolio exposures going through a dislocation scenario. And what you see is a slightly more corporate portfolio. You also see slightly less assets. So banks generally are not going to be selling mortgages and things like that. It'll take them a while to provision assets, so that would be slightly less. Slightly larger increase on things like defensive yield and stress. But this just gives you a picture of kind of how that mix shift could change in a dislocation scenario. So as has been alluded to, we're raising the contingent pool of capital today. It has a hard cap of $4 billion. That fundraise is wrapping up end of this year, early next year, and continuing the partnership with you all broadly at TPG, but also TSSP. We really appreciate the consideration. So, happy to take any questions, clarifications, anything that would be helpful.
Why the reluctance to share your financial statements? That's sort of standard operating procedure for your company, or?
Yeah, so we generally haven't, across all of TPG and many of the private firms, share financial statements with LPs. We are a private partnership, so unlike a lot of our peers who've taken the option to go public, which we can have a whole separate discussion why we don't think that is the case, the partnership is wholly owned by the partners of TPG and TSSP. And so divulging that type of financial instrument information with all private partnership and private individuals, we just didn't think was a prudent thing to do.
You guys have audited financial statements that are audited by it?
We do.
And then this is for Axia, I guess, how can you guys do a complete due diligence without having audited financial statements? In this document, it indicates that you do not think that they have debt on their balance sheet. But if we haven't seen their financial statements, how can we make that statement?
Well, I'd first say that GP level financial statements are probably our laundry list of items we ask for, probably the single most difficult item to get. We understand it's highly sensitive information. Having said that, of course, to supplement that, we have conversations with the CFO or other partners, depending on the organization, trying to get a feel for the financial positioning of the business. That's from a P&L perspective, how profitable they are. We can kind of do that a little bit back of the envelope, see where they fit within management fees, how much capital they've raised, are they successful, are they carrying interest on existing vehicles. And then on the balance sheet piece, I agree, we ask the questions, and they're sort of representing that, but it's hard to know precisely if there's debt on the balance sheet. In these guys' case, I think what I suspect is that I think they're doing pretty well from a management fee and carried interest. And then they've also, as the recent transaction with Dial Capital, which led to some additional capital into the firm. So it doesn't seem, it's hard to envision why they would need to have significant debt on the balance sheet. But it's just, in certain cases, we have to take the representation, we do the best we can to try and get some sort of view into financial corporations.
We've heard a lot in the press on different situations about these non-disclosure agreements. Would your firm not be receptive to sharing your financial statements with a particular LP if they sign a non-disclosure agreement?
Yeah, unfortunately, as a policy, we have never disclosed the financials of the management company. As Tim said, we do calls with consultants like Axia to at least give them a picture of what that balance sheet looks like, but we don't, as a policy, do those financial statements out.
Thank you.
Any other questions?
I wanna just, I don't know the answer to this. So with this strategy that you've got, is carried interest neutral? Or is it unneutral?
I'm at it.
You're a little quiet.
Yeah.
We have, in the last about 12 months, seen different flavors of this, what we call contingent capital, where it's sort of putting a pause on the investment period until materializes. I'm going off memory, but it's hard to think anywhere that I've been looking at. And particularly when you think about the complexity of the strategy, when you're working with a group like TSMP, where you're looking at really truly the opportunity to find differentiated deal flow, versus just focusing on buying liquid credit names, which may be a little bit lower fee than we would expect. We don't think the fees or the level of carry is sort of out of line for this, certainly relative to peers. There are only a handful of groups that are using contingent capital vehicles, everywhere from plain vanilla buying secondary loans at 80 cents, which is kind of a more straightforward strategy, to let's say a more complex end, these like.
I think you'll actually see more of the contingent format pop up, but even taking out the contingent part of it and just focusing on the distress piece, and that's very. And it's hard, it's also targeting for the time.
One more, Mr. Chairman. On your page 12, or page 1, you go into your investment and departures. Did you look into the seniority of those people?
We did.
It just seems like a lot. What's the timeline on the departures?
Yeah, so we had conversations, it seemed like everyone was fairly specific circumstances of why an individual left. I mean, the problem these guys have is a very well-established team that's very credible, so people are gonna try to poach some of their individuals, which is probably the case in 2 seasons. But for the most part, this does not seem like, when you're talking about the size of the platform over a 10-year period, that outside of the number of departures, where it gave us, considerable, I guess like we mentioned, early in the talk that we talked about that. I think what really made us feel good is if you look at the additions to the platform, the people that we've been able to recruit have been high caliber. I mean, whether it be people that are running businesses like technology, like Goldman or other very specific verticals, they're going to be attract talent that makes certainly outweigh any of the other names that you show up on the list.
I think you mentioned the time period that's inception.
Oh, yeah. No part, no place, no part.
Thanks, Mr. Chairman.
I don't remember, was there any comments about cross-ownership investing with this contingent fund? We ever asked to put money into existing tower funds?
Now, the way it works is whether you're part of the main TAO vehicle or you're part of the contingent fund, once the contingent fund is activated, allocations work the same across the whole vehicle. So every LP will participate pro rata based on the unfunded amount upon activation.
It would never be a situation where you're trying to bail out an existing.
No, it will not invest in TSSP funds.
Any other questions?
Based on the recommendations of the Council Investment Committee, non-core fixed income advisor Axia, SIC staff, and the General Fiduciary Oversight RBK, I move that the State Investment Council approve up to a $100 million commitment the TSSP adjacent opportunities contingent, subject to and contingent upon New Mexico legal requirements, the New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Thank you. Any other comments or questions? All in favor?
Aye.
Any opposed? Scott, you're opposed?
Yeah, I just in trouble by that financial statement issue that I mentioned, and being from that profession, I'm just gonna have to vote, I like the investment and all the things you had, just hung up on that. And I guess I probably should have asked the question, if I've been remiss, have we had very many other investments come before us before with financial statements were not shared that I just missed? Because if this has happened, say 10 other times and I just was asleep at the wheel and voted in favor of those, I want to be consistent, which is why I'm asking the question.
Scott, I'll actually generally know, like, give us a chance to talk about ourselves.
I'm not trying to put anybody on the spot.
No, that's fine. Let me have a chance to talk to the asset class director, I can report back to you.
Thank you.
All right, thank you very much. Passes with one vote. Appreciate it.
Thank you very much, appreciate it.
Linda, you had a report there that was probably not.
Well, we did cover these funds, but we
Yes.
covered a number of other things also. First of all, we covered this is the general performance of the fund. And as we will note, the funds are performing exceptionally well. We are actually above benchmark for both shorter and longer term land grant. Incentives tax were only a very few basis points below our benchmark. This is a difficult standard to meet, and yet we've met it for both long and short term. That's really something to be noticed and to be congratulated on. Also, as it's important to meet our benchmark, because we established that benchmark because that type of return will allow us to accomplish our mission of funding education and funding the general fund. So it's very important that we meet those benchmarks, so that's good. As far as asset allocation, the plans that we set in prior years to protect the funds in more volatile environments are working. So as we're going through this more volatile period, we are doing exceptionally well as our benchmark indicates. And that was something that was a goal of ours, was to have good performance even in volatile and down markets. And it looks like it's accomplished that. Also, as these contingent funds are brought before us, another important thing is that our asset allocation is allowing us to have sufficient liquidity that if there's when there's a difficult market and the market goes down, we have cash to invest when everything is on sale. And that's something that many public funds have not been able to do. So our asset allocation is working very well for both the volatile, and it looks like it's prospectively going to work well when the market goes into a correction period. We did look at these three investments. They were unanimously approved by the committee. But what's important, I think, not only to the investment committee, but to the SIC, those issues that I brought up last time, which was, as an oversight committee, we ought to be asking, why are we investing in these funds? And how did we pick these specific funds? Why are we investing? We have been told by our asset class directors and by our consultants. They fit within the asset allocation that we've given for that asset class, for that sub-asset class. Geographically, they are diversified. Type of property, they are diversified. So they are within the allocation that we have, our pacing for vintage years. All of that is why we are investing in these funds. How did we pick these funds? Notice that all of these are managers which we already have in other funds. That is a goal that we're trying to do so that we don't have 150 different fund managers. We have fewer fund managers. But we don't want to just say, we're going to pick these funds because we're only going to pick the managers that we already have. they looked at other managers before they selected these funds. They looked at, is this the fund that's going to provide the diversification as far as type of property? As far as the source of the funds? Is it going to complement the other funds that we have? Is this a well-operated fund? Is there a fund that is better? We are using Burgess and Preqin now as sources to look at funds. We're using Colmore to look at their fees. And are these the best in class and suitable for us? And the answer was yes. So as an oversight committee, why are we investing in these funds and how did they pick these specific funds? And this was answered for us. And I think we have, again, best in class here. So the funds were approved unanimously. Another thing that we looked at was the pacing schedule for the New Mexico Private Equity Program. And Sun Mountain did a superb job in looking at what the capacity is in New Mexico to meet our goals, which not only invest in New Mexico, in economically benefiting New Mexico, but is going to have return to us because we have to have a return in those investments. We just don't go out and invest for the sake of investing. We need an economic return. The years that we didn't have return to us were very poor years for the severance tax fund, and we're still being harmed somewhat by the performance of those old funds, the old funds that we have. So we still want capital return. So what is the capacity for dollars into the New Mexico program, as well as if the market were to go down and we have a statutory cap on how much we can invest in New Mexico, we still want to be able to have plenty of room to invest in New Mexico in those vintage years where the market is down, because those end up being good vintage years. So their conclusion was that about 45 to 50 million a year would be the right sizing for us to have successive vintage years, ability to invest in down markets, and have sufficient capacity out there with what is available in New Mexico private equity investments at this time. They did an excellent presentation, and so that was something we were looking for too.
So does that mean you'll be bringing a recommendation at the next meeting to add another tranche?
Well, we
I said
might not
to-
do another tranche. There are other ways to invest. We can do tranches, we can do funds. So there are different ways that we can invest in New Mexico. But yes, we will be making other recommendations in the future, yes. And that remains about 5%.
Good morning. I think, should we start the meeting now?
After 2 meetings this morning.
Yes, ma'am.
I finally get it.
Okay, because my sense is that there is no, that they don't have any dry powder left in the funds that we've already authorized.
Very good, Mr. Chairman, and we're in discussions on exactly how to approach things.
Oh,
So it won't be that much, but at some future meeting, they still have 20 million or so. It's not-
I'm sorry?
They still have 20 million or so.
Okay, good.
Mr. Chair, what have you seen in the investment environment? From your, I mean, that $10 million is a huge increase. And I think from the last time.
It's going from 35 to 40 to 45 to 50. Is the increase.
What do you think it's going to be? Did you see something?
Well, I can tell you what Sun Mountain told me, but I think it would be better with Sun Mountain, basically, to get the word straight from them. But they're saying that there is increased opportunity in New Mexico with maturing venture capital, which is the kind of thing that we can invest in because it has more promise for economic return. And there's just increasing opportunity out there. And part of it was the change in statute that allows us to invest with funds that don't have to have a physical presence in New Mexico. And that there are just increasing opportunities, but they don't see increasing opportunities for a whole lot more than that in that category that are mature enough that we think we will get economic return from.
And one more clarification, on, under your long-term performance walkthrough, you have a status that is a comparison to our peers is in the top third. How are we really in the top half? What kind of time frame?
Mr. Treasurer, we're gonna discuss that very thing in the
Yeah.
3B.
Okay, but I'm
Yeah.
patient and wait for you. Thank you.
So let's move to, 3B.
Okay, thanks, Mr. Chairman. So in your packet under 3B, you see a series of pages out of reports that you typically get, and it looks like you have those are pages out of reports you typically get, because that's what they are. Now, there actually is a presentation in there, just not a fancy PowerPoint. One of the reasons I did it that way this time was we're only gonna use a few numbers off of each of those pages, and so I wanted to leave those numbers in context that you don't really see them, so to make it a little easier to understand. Well, Mr. Treasurer, we'll jump right in and answer your question right away on page number 217 in your book. This is the only one that's not just a standard page out of one of your reports. It's some consolidated information. On the right-hand side, you see where it says IFX rankings Q2 2018 net of fees. The left side, I'm sorry, the left side. IFX is the ranking system that the LFC uses, and this is part of a report that we briefed the LFC with. So, Mr. Treasurer, to answer your question, there's 1, 3, 5, and 7-year timeframes, all ending last June, so all ending calendar Q2 of 2018. The first column there is the actual return net of fees. The second column is our percentile ranking in the IFX database. So roughly top third across the board, 1, 3, 5, and 7. Still in the 10 years, still affected a little bit by the legacy investments, but that's recently popped up above the 50% mark. I think when we started that 10-year number was buried into the fourth quartile, so we're back to top half 10 years, and roughly top third in the rest of those timeframes. We can slide over to the right-hand side now. You see those same return figures we're still in net of fees return space, but they're compared to our benchmark returns for the portfolio. And you see there the 1 and 3 we popped above, was 44 basis points for the 1 year and 43 for the 3 years of excess return, and roughly equal with the benchmark in the 5 and the 7, just slightly below there. As I look at the quarters that are rolling out of those 5 and 7 year numbers, the quarters, of course, that are rolling in, we're definitely getting a positive flow, so we would expect those negative numbers to turn positive here in the next few quarters, as long as we keep adding good quarters on the front as some of the weaker ones roll off the back. The last thing to consider on this page is the absolute level of those numbers in that first column, so 8.36 for the 1 year, 7.04 for the 3 years. Your long-term rate of return target is 7%. So in every period except for the 10-year period, you're above that long-term target for all those time frames. So on all 3 axes here, against the peers, top third, against the benchmarks, we're generally ahead. In the 1 and 3 we are, and sort of right in line in the 5 and 7, and against your long run rate of return target 7%, we're ahead of that in all periods except for the 10 year.
So Liz, maybe there's a simple answer that I just missed, but when you're watching the newspapers, all the universities are now reporting Harvard, Yale, Stanford, and their return for the second period is substantially higher. They're doing something completely differently than we are.
Their 1 year return is substantially higher.
Right.
Their 10 year return is substantially lower. The main reason is these funds take more risk. The big endowments take, the biggest endowments take more risk. Now the median endowment is about the same as other fund database, about 8.3. So we perform in line, roughly median with the endowment world. But the big ones that you're talking about, they take a good bit more risk. That's why the 10 year numbers look awful. The 1 year numbers are pretty good.
Very highly oriented private equity.
Private equity is what's driving it. I'll see that here in both fund spaces just a minute.
Okay.
And more mature private equity built out portfolio, they
started alternatives.
Yeah, we compete fairly well with the return of our private equity portfolios. They just have a bigger weight.
Right, about that.
So across all three axes, very good performance over multiple timeframes. Is what we're observing here. If you flip the page, one thing you should always think about, of course, is when you see whether the good numbers like that or the poor numbers, is how do we get there? How do we do that? What I put this in here for, and you've seen this plenty of times, is to show that in order to make those returns, we did not take some big bet. However, that used to be the way this fund earned its returns. So at the bottom, on the bottom scale on the horizontal axis, that's time. It goes back to late 1994, all the way up, of course, through June of this year. On the vertical axis on the left-hand side, that's our peer ranking, just like you saw on the other table. You can see historically back in the 90s and early 2000s and even up to 08, the fund really was boom or bust. We were worst to first, we might say, in terms of generating performance against peers. That's mainly because the portfolio was highly exposed to equity. So back in 2010, there was, on an allocation basis, 45% to U.S. equity, 15% to international equity, another 10% to private equity. The real estate portfolio was 100% opportunistic investments, which were very equity-like, and there were equity-like investments in the fixed income portfolio. So all told, 80 or so percent of the portfolio was in equity, and that's how you get sort of that boom or bust pattern. We've diversified that for you to a good extent, and you can see in the recent years here, at least the last since about 2012, we've stayed mostly in those middle two quartiles, and we have roughly twice as many dots in the second quartile, better quartile, as we do in the third quartile. So about 2 for 1, second quarter performances versus third quartile performances. You've heard Matthias and Marcia talk about that frequently, that outperforming the median in shorter periods of time on a fairly steady basis gets a very good long-term return. I think we showed you a study on that once. That's exactly what we have going here in the last few years. So much of the volatility that drove this fund in the past has been removed, and but we're still generating those top third performances that you saw on the previous page. If you flip over to the next one, this is really just our risk profile. This is ex post, so historically, and we'll see what our ex ante or our forward-looking risk profile is. But you can see we've earned those returns, those top third returns, those returns that have beat your benchmarks, and those returns that are above your 7%, with about 85% of the risk of the median fund in public space. So 15% less risk than the median fund has suffered, at least volatility risk, over those 5 and 10-year periods from the land. The next page, so we talked about there's not one big bet in the portfolio like there used to be the big equity bet. But I want to show you with these next few pages that performance that's driven those top rankings is spread across the portfolio. So this first page, page 220, this shows our U.S. equity portfolio. So just your domestic equity investments, the ones that Starlon Fed manages. And you might have to click your plus sign a little bit to get this a little bit bigger. But you can see we're roughly median to above 40th percentile over multiple time frames. So 50th for 1 year, 55th for 2, but 40th for 3 and 4, 42nd for 5th for 5 years, and right about 56th for 7 years. So median or above for your domestic equity portfolios against peers that build these same type of portfolios of domestic equity. The next page is your international equity portfolio. As you can see there, we're top quartile for the last couple of years after the restructuring, when we got the constitutional amendment done. That allowed us to restructure this portfolio to be a little more efficient. We can see roughly top quartile performance since then in that 1 and 2 year period. The next page is your fixed income returns. They're out of the box, your top decile performance.
90% of the peers that build fixed income portfolios like this, when they pick up their performance report, they see lower numbers than you do when you pick up yours. The next page is private equity. We just talked about, and you can see that those numbers across the board are top half, top quartile versus peers. Straight across the board out to 7 years now, we're in the top half. Those numbers were in the high fourth quartile performance in 2010, so we materially improved the performance and quality of the private equity portfolio. And your real estate returns are on the last page of that group, all in the top quartile against your peers that build real estate portfolios for their allocations. That's really something. To be ahead, particularly in top third, top quartile position across your entire portfolio, all asset classes that get measured by the Wilshire Tuck. So that good performance that you saw on the first page, this top third performance on the top page, is spread across the portfolio. Not one big bet, not one big area, not one area where we've done very well and mediocre in others. It's across the portfolio that that performance is being generated. So that's sort of it, Mr. Chairman, on investment performance. Oh, I guess I want to say one other thing. When you see, of course, we see numbers like that, and you say, gosh, it wasn't a big bet, it was straight across the portfolio. How did we arrive there? How did we get there? And how we got there is our annual investment plan. So you see this every year. I've been writing it since 2012. We lay out what we see in the markets. We lay out what we think will happen over the course of the rest of the economic cycle and into the next one. So we look at 7 to 10 years before economic cycle. We talk about the strategies that may work in an environment like that, and propose 2 or 3, sometimes 4 themes that we ought to follow. The asset class directors take it from there and structure their portfolios and start picking managers. And on a monthly basis, then you see the managers come into the portfolio. That process is what generates that performance that you just saw. So this is the wellspring. You'll see us again in June. I've just gotten started on it. I always start in October. I gave just a very brief timeline of how we generate this. And I said, well, that's great. Say that to the council. So we start in October. The IMF puts out a World Economic Review in October and April. So we start in October when they put out their October version, and we study that for a month. I arrange calls with about a dozen strategists and CIO friends of mine, our money managers and other public funds and other folks I've met along the way, just to talk about what they're seeing, what they're doing. And then, of course, we have discussions internally. That's what we'll do from October through the end of the year. January through April, we'll engage the asset class directors on how to move those strategies into the portfolio and changes to strategies into the portfolio. We'll update all of our models, our financial model of the economic regimes, the long-term return assumptions. That's RDK does those. We monitor those and evaluate those. The intergenerational equity model and our economic assumptions table. So all that stuff sort of gets done January through April. Then we'll engage the CIC management group, council, and then in June you'll see the 2020 report after all that work is complete. But this is where that starts. That good investment performance that you just reviewed. So let me stop there, Mr. Chairman. See if any questions anybody wants to say. And then I've got one more little piece, and I'll flip it over to RBK for your monthly report. Okay. So the second piece, so that first piece we gave the LFC in a budget meeting that Steve had set up with those folks a couple of weeks ago. The second piece is just more market update action. And the first page there you see is 225 in your book. This is just from a well-known large investment shop. And I've highlighted some things on there for you to take a look at. Market action has been indicative of late cycle pressures, and they expect for those to persist, which you already know that because we have reports like this that come out of the annual investment plan. So this is your late cycle market report. We went over this, I think, in May of this year. So you already know what late cycle looks like. In here, we talked about how late cycle happens, how it normally plays out, what sort of things tip us over into the next piece of the cycle, which is recession.
what sort of strategies tend to work in late cycle markets, how markets tend to react, so forth. So you've got a good base for what is now playing out, and reports like this sort of show others are starting to see that late cycle when it's starting to happen. But you're already prepared for that. You know what's coming at you, and are prepared for what you'll be seeing in terms of investments coming in each month in our discussions on asset allocation. If you go to the next page, you recognize this out of that late cycle report. Just as an update, I think we're ready to move the central bank policy piece from starting to tighten to tightening. Fed's got rates up now to about the rate of inflation, so we think further movements from here will constitute actually tightening monetary policy as opposed to just normalizing it as we've been talking about the last few quarters. And then risk appetite, I think we can move over to the high section there in late cycle. There's not much difference between mid and late. That's just a function of tightness of credit spreads and how high the stock market was before this recent sell-off. So further movement into that late cycle environment is where we're headed now, almost fully into late cycle. By the time you see your 2020 annual investment plan, I think we'll be fully in late cycle and probably stare at a recession in the face. But that's okay, because you have stuff like this, your liquidity plan, on what we're going to do when that recession, what we propose to do when that recession hits and markets start falling apart. We just saw one of those funds today that is how contingent is in place. But this study that we did, it's been over a year, April of 2017, says, here's where your liquidity is located, here's how much you have, here's why we think we need to have this much, and we're ready to deploy it when markets tell us it's time to put this money in higher risk assets. So very safe, now it's about 10% allocation to very safe investments, primarily treasuries, in short duration assets. And I've got a couple percent of cash on the balance sheet going into this latest little sell-off. So I think as Linda was saying, our posture was, we were ready for what happened here in the last few days, and we're further ready for what could happen once we do tip over into recession, which we're not necessarily expecting. My pet theory about why the markets are off now and not quite recovering is that the marginal buyer in the stock market seems to be corporations buying their stock back, and that may be the strongest buyer in the stock market right now. And it's earnings season if they can't do that. So once we're out of earnings season here in the next couple of weeks, hopefully that marginal buyer comes back in, markets tail back up. Economically, that's not the type of rate of going into recession yet. And so we are expecting a little bit of a market bounce back, but we'll see. That's sort of that theory. Next page in this packet, we're almost. I have to apologize. This is the wrong table, although I was going to make two quotes. I could make one of them, and the other you just have to believe me. The one where I'm asking you to just believe me. You may have to blow this up. It's tough to see the numbers. Bart Stuckey follows these are other public funds here. Bart follows these really close. This is the asset allocations of these funds. We run these allocations through standard market indices to sort of guess how other people are performing. We miss on an individual fund basis because each fund has the level of alpha, either positive or negative, moves their number around. But when you total it up, the total we usually get right within a few basis points. Unfortunately, it's the wrong one. It doesn't list the performance. It just lists asset allocation. But I can tell you it is in order of performance. So the fund at the top, if the year ended as of a couple weeks ago when Bart put this together, if the year ended a couple of weeks ago, that fund at the top would be the best performing fund out of the 37 or 38 that we have in there. The fund at the bottom would be the worst performing fund of that stack. We fit in the fourth slot. So I've been telling you, and I showed you the volatility chart, the second page in, and we don't bounce around a lot and don't expect really to see the top quartile, which you can also not expect to see the bottom quartile very often. And I'm afraid we're going to be in the top quartile if the year were to end today, or if the year would have ended yesterday, or last week whenever we finished this up. So very good performance, that defensive nature of having that cash on hand to deploy in the next recession, and also a little bit of cash on the balance sheet has jumped us up the league tables in terms of performance relative year over year.
just to make sure I understood what you said. If we had been inside the chart here, we would be following Illinois.
That's right.
Okay.
Yeah, we'd be following, one above that.
Oregon.
Yeah, we'd be going before. Okay. This is number 37. So, sorry about the phone chart, not having the numbers in there, I think it'd be interesting for you to look at. The second point, though, that I wanted to make about this chart that you can see on there is a little over a year ago, we had plenty of articles out in the paper about 60/40 and 70/30 or however, whatever risk level you want to take, indexed in public assets. Why in the world weren't public funds doing more of that and less of the alternative investments? Once the markets kind of rolled over a little bit in February, those articles disappeared. And if you look at that fund on the bottom, they are 60/40 almost exactly. And they're in last place in the league table here. The point, and the only point is that index public markets, whether it's 60/40 or 65/35 or 70/30, however you look at it, is not a panacea. There's times it works well, and it was working well a year ago, but there's times it worked poorly, and that's today. So that's the really only point I want to make, or second point I want to make on that. The last thing we'll talk about here, and then we can move on to your monthly performance sheet, is the black dot chart, we call it. The reason I wanted to look at this again with you is, so we've seen historically, we've been successful over multiple periods across all three axes of peers, benchmarks, 7% targets. We talked about how we got there and how we're doing currently, but how do we look going forward? If we think about the return assumptions that RDK has, we run our asset allocation through that, how does that stack up relative to what other folks in your position in terms of those years are looking at? And so here you can see, and we've seen this chart before, with just a brief explanation. On the bottom is risk, that's volatility. On the horizontal axis, or on the vertical axis on the left, that's annualized return. This is using the long run assumptions that you see in the table above for the various asset classes. And you can see where the land grant is positioned with your blue diamond relative to 37 other funds. So we take those asset allocations we saw on the previous page, we run them through RBK's long-term assumptions, and we plot them on this chart along with ourselves. So there's only about 5 funds out of 37 that if RBK's assumptions are close, or reasonably close over the next 20 years, that's how things are going to sketch out. There's only about 5 funds that will earn a higher rate of return than land grant is expected to based on these assumptions.
Are those targeted or actual investments?
Those are targeted asset allocations, as close as we can get. Sometimes we have to use the actual. They don't vary too much, so we're roughly the same. People generally stay fairly close to their target asset allocation. So we take slightly more than above average volatility risk. You see the average is below 12, or about 12.25 for expected volatility. But we're quite close to the efficient frontier based on our asset allocation relative to the rest of most of the rest of this fund. We see the maximum risk that a fund takes is about 14.5 or so. So not a huge jump over the risk that we take. It's probably the wrong time to decide to be doing that. Expect for us to be out there, which you can expect for us in the next recession. Put that cash to work, put that short-term investments to work, and see us pop out the risk scale on funds. So, Mr. Chairman, that wraps up sort of the current markets, and I'll take any questions that you have.
So we have the performance through August, right?
Maybe real quick. Does anyone-
Very quick, because it's way out of date.
Just looking at your August report, 2:30, just a couple of comments about the markets in August. Equity market, domestic equity markets were the best place to be. International markets, because of currency and more importantly, because of trade concerns, we saw negative returns continue in the non-US equity markets. Bonds performed well for the month. Oil was up over 1.5% for the month. We saw the yield curve flatten with yields on the short end going up, but expectations for
monetary policy pushing the yields on the long end down. So it was a expected month. If you go to page 230, page 2 of ours, and you look at the bottom, you can see the performance for the month, you were up 0.58, and for the quarter, 1.98. Again, this is as of August. If you look at the trailing numbers, you can spend a lot of time looking at trailing numbers, but you can see that it's, post the end of June, looking at those numbers all in excess of 8% on an annualized basis. So you get out to the 10-year number, which was at 6.61 on a net of fees, that was 6.4% on the 10-year, but up to that period, all above 8%. That's for the total fund, and then you can see the land grant outperforming and the severance tax slightly underperforming in the short term, but long-term numbers look strong. Going to the next page, you can see the market values, net cash outflows, and gains in dollar amounts for each of the individual, for the total, and then for the individual funds. This is reported on a calendar year-to-date basis. And then on page 232, you have your composite performance. No surprise here, for the month, the best performing asset class on an absolute basis was U.S. equity, followed by core fixed income, which had a great month. If we look for the quarter, it would be U.S. equity, again, the best performer, followed by your non-core. Now, this is an August report, so we don't have returns for the alternatives, so these are preliminary numbers. And Matthias is gonna say a couple of words, some words on the attribution, which is on page 234.
Yeah, sure, on two.
I'm sorry. Can I say one thing? Can I take you back to page 230? Vince would kick me for not doing this. This is looking at your target allocation versus your interim target allocation and your long-term. Just make a point here on that non-core underweight. You've reclassified, as Paul had mentioned, the only financial asset you have in your real return bucket is your MLPs. You used to have your bank loans and your hedge funds, fixed income hedge funds, waterfall. Those will be transitioned in the September report under non-core. So you'll be much closer to your target allocation for your non-core when we look at the September report. And now, sorry, Matthias.
No problem, on 234, this is one of our favorite pages because it really is a scorecard. It shows how the program is doing overall and how those decisions are adding value. In the top chart, you can see the blue line, that is the strategic asset allocation in the policy index, and where the majority of the value is derived. 93% of your total return, in fact, comes from that. That's important to monitor, and it's actually nice to see that you have positive manager skill. That's alpha that your managers are producing. That makes up about the other 5%, with the two other lines, tactical assets allocation and style, being fairly negligible, and that's by design. What's interesting on the bottom left, where we start breaking down that strategic asset allocation and policy index, is that all asset classes are positive. That's relatively unusual, and as Vince mentioned, you do have very strong relative performance compared to your peers across these asset classes, despite this very supportive environment that we've seen. On the far right-hand side, you can see, and again, this is all over the 1-year period. You can see that the alpha is fairly persistent across most asset classes. U.S. equity and private equity, getting back a little bit. I think for U.S. equity, some of the positioning defense that you have lower beta, some of that performance makes sense. And I would say on the following page, I won't go through it. That's for the 3-year period. You see all the same things, but actually even more persistent, with the bulk of the returns coming from the policy index and all asset classes being accretive. Just because based on the timing, the August numbers are already dated for those that maybe haven't seen what the year-to-date numbers are for through yesterday. The S&P 500 is up 4.6%. Developed non-US is down 8%. EM is down 13% now. and fixed income is down 2.5. So it will be very interesting to see, and I think you're well positioned for this next
That was calendar year to date.
calendar year today.
Does it look to me like, I was just looking at Mrs. Linda, that it looks like we're gonna have a pretty hard time making 5% for the year. Is that, in other words, if you look at the calendar year to date, it's 3.56. That's through 8 months. So over the next 4, the total fund composite, the whole thing looks like less than 6% for sure, and pretty close to 5 is what it looks like.
Oh, my pet theory is we'll get a Santa Claus rally here.
Oh, yeah, well, yeah.
November, December, we'll see there,
Yeah.
no idea.
Put up, you're like, yeah.
I think the probabilities are at least tilted in that direction, so possibly we could be 5.
Next item on the agenda is on for discussion, unless there are any questions. It's the typical private equity required recording. Seeing no hands, I'll turn to Steve.
Of course, thanks, Peter. The total distributions to the state from the funds through through September, 922.4 million. West Texas Intermediate Oil at 69.25 as of today, and as all of you know, and as we mention each month, New Mexico is probably 15 cents less than that. And I always say cents, I meant dollars. At $15 less than that, and as soon as we get our transportation issues resolved, hopefully that number will be less. Net asset value of the funds as of this morning, 23.9 billion. Please take a look at my report there on page 254. And if you would focus on the top right-hand corner, which is the message that we try to deliver every time we speak to a different group or have an opportunity to meet with an editorial board, which I will mention to you here in just a moment that we have done recently. Here we're seeing that as distributions, as I should say, in the bottom portion of that, as the market value of the funds, the net asset value of both funds increases. So do the distributions. This is the endowment model. This is what so many people miss. This is what is not well understood. As we encourage folks to just let the value of the funds increase to the degree they can. And as a result of that, more will be distributed. Then if you would look under B at council matters, we will have the audit exit conference, as Brent will explain here in just a moment, early this year. Brent can give you the specifics on that. You see the 2 other meetings that are scheduled for November, and the November council meeting being the last for 2018. Under operations, we're still looking for a couple of positions. We'd like to fill our public equity analyst position. Starla's working on that. And Carrie and Brent are together working on finding a proper administrative assistant to sit in the front office and to assist both Carrie and Brent with the tasks that they have. Land grant inflows from the state land office. You'll see what we have specified for you there. And then as you look at the last page of the investment holdings report, you'll see the monthly contribution from the state land office, a decrease of about 1.5 billion from August. That amount was 71.4 million as opposed to 36 million the year before. the decrease of 1.5 million, if I said otherwise. Then if you would, take a look at the mention of a new client coming in. The city of Albuquerque is in the process of signing the joint power, JPA, the joint powers agreement with us. And they'll be moving funds to us sometime between now and the beginning of the year. Charlie, do they have an allocation decided yet?
So the city of Albuquerque manages, fixed income in-house, or through various other ways. But they're looking to, use about $40 million, and put that into the equity markets, a very conservative structure. So, well, they are looking to increase their yield based on.
So they'll come
these
into our
assets.
equity pool.
Yes. All right.
Less conservative than what they're doing now. Then under C4, you'll see that we had initial meetings with both BFA and LFC to discuss our budget, hoping that this year, both of those entities and the legislature will allow us to have the budget we've requested. The process is unique in New Mexico, and we hope that by explaining in detail why we've asked for what we've asked for, perhaps those entities and the others that oversee us will understand that we're not asking for more than we should, and we're trying to spend prudently, and they'll allow us to have the requested amount as the council has reviewed and endorsed. We then will have our initial budget hearing on Thursday of this week, and invite any of you who are interested to tune in on the web. Under external relations, a few interesting things there. As all of you know, we're trying the best we can to educate everyone that will listen about the permanent funds. That's the reason we did the 60th anniversary report. That's the reason we travel around the state speaking to whatever groups are willing to allow us to speak with them. If the public better understands the value of the permanent funds, we know that they will do their best to encourage the council, the legislature, the executive to properly oversee and manage those funds. So we spoke recently to a Rotary Club, as I mentioned, a small Rotary Club in Santa Rosa. We will be meeting with the Los Alamos Chamber of Commerce and other leaders in Los Alamos on the 13th of November. We met with the editorial board of the Santa Fe New Mexican the 15th of this month. We try to do that as often as we can, but I've almost been here 9 years. We've done it twice in those 9 years. But they were interested. We met with two of them who are the senior people editorially from the paper.
Was it yes?
We had good questions, Governor. I believe they understood what we wanted them to, and we felt good about the reaction.
I mean, is there still a desire to raise a fund and?
We didn't feel that at all. None of the questions that were addressed to us had that angle. No. Now, what they will write could be different. We know that their thinking is different from the thinking of the Albuquerque Journal and others. But we were very pleased with the reception. We took the 60th anniversary report, looked at several different pages of that with them. We talked about new money that is generated from the funds each year and how that money might be used. And I know Lee's commented about the fact that that's expected money, I understand that. Nevertheless, it is increased funding, so we'll see. Our intent was not necessarily to try to influence the editorial policy, and that honestly is not why we were there. We were there to try to get them to more thoroughly understand what we do.
I mean, when I travel around the state, I hear, you know, $23 billion sitting in a fund and all the needs of the state. And what are a few billions over, you know, amongst friends? And let us take some of those and spend it with raising salaries, which then becomes a recurring for, you know, a variety of entities and agencies. It just, those are the organizations I think don't understand that if it doesn't grow, there isn't more being put in. Because there's going to be a big, I mean, unless Senator Smith, of course, stops it, there's going to be a big fight to raise it. A big fight. Because it's just grown so much, and they don't get the nuances. They just see $23 billion.
We've looked at the growth of distributions over the past, let's say the past 3 years, where we've gone from 838 million fiscal year 17 to 968 million for FY 19. We're projecting another increase for FY 20. We appreciate your trying.
Meet with the unions. I mean, sometimes there's a lack of understanding of, you know, it's just it's complex, and they see it, and there are needs, but there are other pockets of money everywhere for building schools and fixing schools, and they've received raises that they definitely deserve. You know, exemplary teachers and good teachers definitely deserve raises. And they've rated this once before with 0 results in the education system. And so, and I think that the business community went along with it and thought, okay, let's give this a shot. And then we still have the buy.
Charlie and I did some research along with Jody this past week about what had happened to Colorado's permanent fund. The former Rocky Mountain News, which doesn't exist anymore, did a series of articles on this. And they had a substantial permanent fund at one point, and today they barely have a permanent fund. There's a lesson there. And for any of you who are interested, we'd be happy to pass those articles along to you.
It'd be interesting to do a side-by-side, you know, Colorado, this is where it was healthy. New Mexico, this is where it's healthy. This is what they did that we didn't. And showing us side-by-side to say, this was where we can end up. If we can, you know, start digging into it.
We'll do our best to keep that from happening. I hope others will too. Anyway, we met with a New Mexican. We are planning, hopefully, to meet with leadership in Las Vegas as well as Clovis before the end of the year. We've asked to have those meetings set up. And I think Highlands University Foundation is going to help us in Las Vegas, and Clovis Community College is going to be helping us organize that community forum there. We take our 60th anniversary reports, we hand those out. We encourage people to take those home and use them for bedtime reading or other reading. One other point, if I may. We're preparing a transition package for the next administration. We also hope we'll have an opportunity to brief new legislators. And finally, I said one, there are two. We are discussing with those who are involved in this, how the tax stabilization reserve should be invested. We met with Duffy and her staff. We've met with David Abbey, Dawn, and their staff. And we are offering to invest that rainy day fund, if you will, the tax stabilization reserve, so that it can earn a bit more than it would short term. We have been asked to have a draft bill prepared, which we've done. We'll be bringing that to you. And we've asked RVK to work with Vince and staff to do some projections of how we might be able to add value there. So we'll be bringing that to you next week. That's all, Mr. Chair.
Thank you very much. Question, please. If you could forward the draft bill, I'd like to look at it sooner than later.
Happy to.
You mentioned that you've been trying to talk to everybody that will listen, so I'm just trying to find out, how did your discussion with Michelle go?
That was about. Governor, we've all been there.
I know.
Or we all currently.
This is, I'm not sick, I have bad allergies.
That was about 3 months ago, Lee. Charlie and I met with her for about an hour in Albuquerque. Went well. She listened to the things we thought were important. She did mention that she saw a need for additional funding for early childhood and other things that she felt could be provided by the permanent funds. And we did our best to convey the feelings that we believe are held by you and other members of the council.
Early childhood currently has been provided more money than ever before. And you can take out $1 billion this year and give it to them, and they won't have the infrastructure, they won't have the people, they won't have the employees, they won't have the infrastructure. It has to go very slowly when something is increased like that. You can't just dump millions of dollars into a program and go, poof, there you are. Every kid's taken care of from the age of pre-birth to whatever. And there's more money in pre-K, more money in early childhood than ever before, because it was built in a way so that we had the employees, we had the buildings to have pre-K in. Because they don't all exist all of a sudden, and then to just yank a big chunk out of this fund, it sits and it doesn't grow. And I think that's the part that people don't understand, is that just can't, it's got to develop. And, you know, and I don't know if it's a political season, I really do think, I mean, some people want to take advantage of early childhood care, some don't. Parents get to decide, but it's not poof. And you don't have all the experts and all the training and all the colleges producing people that can do that. It's practical, but you cannot do that and then say, ha, got all our kids taken care of and overnight. It sounds good, it's a good soundbite, but that's what it is.
Ulterior motives. We might need some of that incoming airmen.
Jesus. No, that could get interesting.
Okay, I know I'll move to Brett.
Just a couple of items.
So we got.
As I have done in the prior months, you'll see the budget to actual comparison and the investment holdings report for September. I did, as all of you know, I forwarded out the agreed upon procedures for the last quarter of the past fiscal year. And you should have that. If you have any questions, I'm happy to answer those. I did point out in my talking points that was a last contracted piece of deliverable that CLA had pending. We now have a new audit firm this year, Moss Adams. We are working very diligently to complete that audit. Tentatively, we have an exit conference scheduled for November 1st in association with the audit committee. If anybody's interested in dialing into that, please feel free to do so. And just so you know, relative to that exit conference on November 1st, the due date of that report is not until November 21st. So we still have time should we run into problems. I did want to point out, and Scott probably knows this better than anyone, anytime you bring on a new audit firm, there are challenges. We're finding that this year it's a little harder than it has been over the prior 6 years, but I think it's good. I think we're making some good progress at this point in time. I'm not familiar or know of any findings or anything that would cause me any concern, but we're not done with the audit. But if anybody would like to participate in the next conference, it is on November 1st, and that's all I have.
Brent, is there a timetable for a draft that we come to this?
I'm glad you asked that, Peter. I know the report is fairly thick. It's probably going to be not much more than a day before. We are really pressed for time right now. So, that's probably what I'll be shooting for, best case. I mean, I guess if something happens that will be pushed out sooner, I'd like to do that, but we're already 3 weeks ahead of the deadline, that November 1st deadline.
I realize that. Okay, thank you. There is no governance report this meeting. So we're ready for closing matters, I believe. Does anybody have anything they would like to talk about or do? Next meeting is right after Thanksgiving, 9 a.m. here. No public comment. Perfect. So, the motion to move to adjourn. Second. We're in adjourn. Thank you so much.